This is Jim Martens, Senior Currency Strategist at Elliott Wave International. I wanted to take this opportunity today to talk about expectation. I'm often asked at the end of a pattern, what can we expect? So today, I've taken the opportunity to look at this Euro-Swiss chart. You'll notice it's a daily chart. It's been in a downtrend, and the decline is in 5 waves. So we had a decline from October to November for wave 1, a recovery to the end of December in 2, a fall off in wave 3 to January, a corrective rebound wave 4 into February, and then finally a decline in a 5th wave that ended presumably in March. So what can we expect from here? Well, I always like to go with the minimum expectation. If it exceeds the minimum, that'll be fine. But let's start with the minimum. I can look at the Elliott Wave Principles book to find that the first thing to look for is a return to the area of the previous 4th wave. This is a guideline. Often to the upper end of that previous 4th wave. So on my charts, I'll often just throw a horizontal line across there. So in this case, right around 162. The previous 4th wave pushed just above it. But I don't have to stop there. We can add the Fibbo retracements once we think that the low is in place. In this case, today we've seen quite a reversal here, and that's a pretty good signal that a bottom is in. If needed, we could adjust it later. But for now, we'll go ahead and put the Fibbo retracement levels, the 38.2%, the 61.8% retracement levels on the chart. And you can see that the upper end of the previous 4th wave falls within this range, ending at about the midpoint, what would be the 50% retracement. So now we have 2 areas to look for, and particularly the lower half of the Fibbo area. So now if we're looking for a correction, we would look for the market to return to this area in 3 waves. And as it unfolds, of course, we could look at the internal structure of that move. If Euro-Swiss were to rally to the 162 area and do so in 3 waves, that would increase the likelihood that the move is corrective, assuming the bounce stalls. We could also look inside that bounce and look to see if wave C is somewhat equal to wave A, equality being the most common relationship. If we saw that pattern, a 3-wave bounce, into the Fibbo area, into the upper end of the previous 4th wave, in 3 waves, and the market started to stall and turn down, we could conclude that it's likely a corrective move. However, if the rally or recovery unfolded in 5 waves to the 162 area, it could still be a correction. That could just be wave A of a larger ABC, a wave B to come, and maybe the market moves up again in a second 5-wave affair and wave C to the upper end of the Fibbo range. But that would be the first warning that maybe this is the bottom to something else. Of course, we would have a larger perspective to work from. If I saw this in real time, I would look back to the weekly chart instead of the daily and see, is this 5 down, possibly wave C of a flat? If it is, then we could automatically conclude that we're probably going to rally in 5 waves off the low, and that's the first wave of something larger to the upside. If, however, we conclude that no, this is not part of a flat, rather there was a peak up here, then this is wave 1 or wave A of a larger move to the downside. So while we're talking about expectations here, perspective is also part of the puzzle. So today let's leave it at that. We've talked about minimum expectations. We've talked about first the count. We know there should be a bottom forming. We've talked about the guideline that suggests a return to the area of the previous 4th wave, likely the upper end, and adding the Fibbo retracement levels to that, looking for a cluster of targets. And then I followed with that talking about how we would follow this recovery and see whether it's in a trend defining 5 waves or a corrective 3 waves. Thanks for taking the time for listening. I'll talk to you next time.